Now in strategy 3, we're going to talk about doing 2 different transactions as opposed to just one before, where we just talked about buying puts, one, or buying calls. Now we're going to combine options with stock. And this is simply an insurance play here, and it's buy stock, buy puts. Now, I mentioned before that you wouldn't think of driving your car out of your garage without having insurance on the car. You wouldn't own a home without flood, wind, fire insurance. But practically everybody who trades stocks doesn't have the position hedged unless they take strategies such as this. This is a conservative strategy just in case to protect you with a hedge if the market were to go down when you buy the stock. So the technique is to buy puts as insurance against a stock decline. The environment you want typically in this is a bullish environment. You want the stock to go up in value so that you can make money on it. But if it doesn't, you don't want to lose money on the stock if it were to go down. And I can't tell you how many times I bought stocks that went down where I should have owned puts, and I didn't, and I wish I had, because the put will protect you in that case. On the upside, what do you have here? You've got an unlimited potential for profit on the upside because you own the stock. And what it does by owning the put is it locks in the selling point in the down market. So you buy 100 shares of XYZ, you buy an XYZ put at the money put, say, and if the market were to go down, whatever the decline is, it's off, the loss on the stock is offset by the increase in value of the put. The break even is where the gain in the underlying offsets the put premium cost. So whatever you pay for the put, you got to make that back in the market. This is a conservative strategy because you've only have the added expense of buying the put. The problem is, what if the market goes up sharply and you still own the lower strike put? In that case, let's say, for example, you buy the stock at 20, you buy a 20 strike put to protect yourself to the downside, and the market soars to 30. Well, the put, of course, won't have much value, but the stock will. If the stock were to decline now back to 20, only then would the value of the put kick in. So what I'm saying is, in this scenario, you'd want to think of rolling up the put to a higher strike to protect yourself in the case of market adversity. You've got a paper profit, protect it by rolling up the put to a higher strike. So think of this strategy as purchasing insurance with a deductible, depending on what the cost of the option is. If the stock surges, consider buying higher strike puts to protect the position. Otherwise, you're at risk down to the original strike. Again, you buy stock at 20, you buy a 20 strike put. Stock goes to 30, you buy a 27.5 strike put, or perhaps a 30 strike put. That'll protect you, lock in your profits. Whenever you have paper profits, as you know, in the stock market, unless you sell the stock, you're liable to lose those profits if the market goes down. The out-of-the-monies provide cheap insurance, and you can roll them up if the stock advances. The equivalent strategy to this is buying a call. Now, in the chart here, the chart illustrates that the cost is the cost of the put, and that's the cost of doing this strategy. Whatever that cost is, you can't lose any more money, and if the stock goes down, you still get that selling price at the strike. Stock goes up, you get to make the whole thing. Okay, in this case, strategy number 3, I have an example of buying the stock, buying the put. And the stock I picked was Carnival. It's recently traded at 53.55. So you buy 100 shares of that. That cost you $5,355 for 100 shares of Carnival. And at the same time, you buy the July 52.5 put for $320. So that's your cost of protecting yourself, and that means you can't lose more than the $1.05 difference between the market price at 53.55 and the strike at 52.50. So the cost is 320. The break even on the upside is now 56.75. Now, how did I get that? I took the strike price and I added it. I added the price. Actually, I took the market price and I added the price of the put to that, meaning Carnival now has to go to 56.75 for you to break even on this strategy. The movement in the stock has to overcome the cost of the put in this case. To the downside, you've got the market risk. The market risk is the difference between what you paid for the stock and where the strike is. In this case, it's $1.05, and of course the cost of the put. So you'd have to add those together, and that would be the cost of this strategy.